Hey guys, please do subscribe to the channel if you find our content useful so that we can keep putting out free resources for the less privileged. In this video, we're going to be looking at the financial statements and how it links with one another. So how a change in the cash flow statement would go on to affect the balance sheet and the income statement. So we're looking at the connections between these sheets. So the first thing we're going to look at is the balance sheet connections. Now, if you could recollect the previous video that we put out for a cash flow statement, the ending cash balance should equal to the cash component that you have on your balance sheet. So in this instances, the ending cash balance in a cash flow statement is 25 million. It should be the same on the cash component in a balance sheet. The next thing to keep in mind is your total assets is the same as your total liabilities and your equity. Now, it's very important to know your balance sheet should balance out. So think of a seesaw, and it should essentially be standing still. In our first video on the balance sheet, we put out a very important equation, which is assets is equal to liabilities plus your equity. In layman's terms, what this means is what you own is dependent on A, how much you owe, and how much you're worth. So let's have a quick look at the examples as to how the balance sheet gets balanced out. Let's presume you have a pizza shop, right? And you're gonna pay one of your vendors $10 to get some tomato sauce. So the first thing you do is you take out $10, which goes out from your cash component. So your cash goes in a deficit of $10. Now, because the tomato sauce is going to be used to make pizzas, it essentially goes back into the inventory section. So you add $10 to the inventory section. Keep in mind, inventory section is basically any section that has to deal with raw materials, or your products that are half finished or not completely finished and not shipped out yet. So imagine another instances, right? Imagine you had to pay $10 out for electricity, right? In that instances, it doesn't go in inventory, it goes out from your accounts payable. So you got minus 10 going into your accounts payable. Now, let's have a look at another example. Say that your net income has increased by $10. So say someone's bought a pizza from you and you've got a $10 coming in. So essentially your net income increases. Now, what this means is your retained earnings on the balance sheet increases by $10 as well, and so does your shareholders' equity as well. Because you've got money coming in and it's been put on the income statement, it directly goes on the balance sheet, and you've got a surplus in terms of retained earnings and shareholder equity. That's how it balances the sheet out. So, as a quick recap, if you take money out, the first thing that's going to happen is it has to be redistributed within an asset. So going from our first example, you're taking out tomato sauce to make a pizza. What it does is you take money out, it adds on to the inventory section or other assets. Now let's presume that you're not taking you're taking the money out for a purpose that has nothing to do with your product. In that instances, it takes a minus from your accounts payable, and it goes into your liabilities. Brilliant. Now, what happens when your net income increases? So you have a customer coming in, they buy a pizza off you, they give you $10. So what happens is your net income increases. And what this means is, once you've got that $10 coming in for your net income, you've got an additional $10 going in for your retained earnings. And that same $10 also means that you have an additional $10 into your shareholders' equity.